if you've done a good job of savings, you've got money in, the different tax buckets. And if you have money in after tax, well, we may be able to live on that bucket, take down not just interest, but also principal. Therefore, kind of tricking Uncle Sam thinking that, you're really not earning anything. Well, that opens up that door to be able to do the Roth conversion, even do more of a conversion. Really try to maximize as much as we can, getting from tax deferred status over to tax free.
Starting your route to retirement.
Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group and your host of the Guided Retirement Show. We're going to talk about my favorite part of the tax code today. It is written by Senator Roth back in the late 90s, and it is the tax code that surrounds the Roth IRA. Joining me to discuss doing Roth contributions or conversions, both pre-retirement and post-retirement, is Will Doty, certified financial planner here at Barber Financial Group. Enjoy the show. Before we hop into today's episode, I want to remind our listeners and viewers that you can access the same financial planning tools we use for our own clients on your own time, and all from the comfort of your own home. All you need to do is visit the link in the show notes and click the Start Planning button. From there, you can start building your retirement plan, no cost, no obligation. All right, so we're here on the Guided Retirement Show with Will Doty, certified financial planner. Good to have you back on the show, Will.
Thanks, Dean. Appreciate it.
You betcha. So we're going to talk about my favorite part of the tax code. And yes, I do have a favorite part of the tax code. Everybody thinks that the tax code is totally evil. But back in the late 90s, Senator Roth wrote a piece of legislation that formed what is now the Roth IRA, the best part of the tax code ever written, bar none. And the reason I say that is because once you have money in a Roth IRA, if you follow the rules, that money becomes tax-free forever.
Yep.
Right? Forever. And I can't think of a better spot to have money than in something that is tax-free.
Well, and if you think about it, it's not actually forever, Dean, because of the Secure Act.
Well,
so we'll have to get into
for
that.
as long as it's in the Roth, and when
Yes.
it's coming out of the Roth, it's tax-free. Now, once you take it out and you put it into another account,
Yep.
that account could be taxed. But yeah, the Secure Act did mess up that being able to stay forever and ever and ever, multi-generations.
Yep.
But for the individual that puts that money in the Roth, they're done.
They are.
Think about it this way. What if, Will, you got to take home and support your family and do your savings and everything else, every dollar that you earned, as opposed to having to give the FICA tax, the Medicare tax, the state income tax, the federal income tax. Your paycheck is eroded every single month by taxes, right?
Yeah, it is.
How would your life change today if none of those dollars had to go out for taxes?
Oh, it'd be drastically different.
Well, that's the Roth IRA.
It is.
That's the Roth IRA. The Roth IRA, once your money's in there, all your future earnings, all your future distributions, as long as you're alive, are all tax-free.
It's powerful stuff.
It is powerful stuff. And the longer you can have your money in that Roth IRA, the more the compound interest gets to take effect. And so the bigger of a deal that becomes.
Oh, yeah.
So let's go to how we can get money into a Roth IRA.
Okay.
Two ways. You can either contribute to it or you can convert into it.
Correct.
Let's start with the contribution, and let's start with an example of a younger couple. They're maybe a few years out of college. They're in the first early part of their career. They haven't yet had kids. Maybe they're getting ready to buy a house, but they've started contributing to their 401k. And we're going to assume for a moment that their employer offers both the Roth version of the 401k as well as the traditional version of the 401k. Where should that couple save?
Well, I mean, they're early on in their career, so their incomes are probably pretty small. So therefore, I mean, should they want tax deferred savings today? Probably not. Probably not the wisest decision. Whereas if they go into the Roth while their income's low, obviously as we do projections, hopefully their income's growing and therefore later on in life, they're going to be at a completely different tax rate. So therefore, it may make a lot of sense today to not take that tax deferral savings, go ahead and get that money into the Roth so it'll start growing tax-free for the rest of their life.
Yeah, let's think about this. Let's give a good example for our listeners or viewers here on the Guided Retirement Show. And by the way, if you're listening on podcast, you can see us on YouTube. If you're watching us on YouTube, you can also find us on your favorite podcast app. Just look for the Guided Retirement Show. So let's just give an example. Let's say that somebody decides to defer, and I'm going to use a flat dollar amount, $5,000 per year into their 401k plan. They're early in their career. So if they put that $5,000 into the traditional side of the 401k, that's going to save them $750 in taxes today.
Correct.
Okay. So somebody might get a little bit short-sighted there and say, well, that's $750 of taxes that I didn't have to pay today, which means that's $750 more that I could spend today.
Yep.
Right?
Exactly.
Where if they put that money into the Roth portion of the 401k, they have no tax savings. So in order to put the $5,000 in, it cost them a full $5,000.
Yep.
But the good part of that is every dollar that account earns for the next 30, 35, 40 years, depending on how old they are, all grows, not just tax deferred, but tax free.
Correct.
So you and I are both part of Ed Slott's Elite IRA Advisor Group, and I think Ed Slott has the best explanation of this. He said, think of yourself as a farmer.
Okay.
And a farmer in traditional world today, they go buy the seed to plant. They get a tax deduction for the cost of the seed. They then plant the seed, and the harvest is all taxable.
Okay.
Okay. What if that same farmer could go buy the seed and pay tax on the seed before they plant it, and then the entire harvest grows and they get the harvest tax-free?
That would be amazing.
Which one do you think the farmer would choose?
The second one.
Yeah, and it would be a no-brainer, right?
Exactly.
So the Roth IRA really works like that. The seed, in your example for the Roth IRA, is your contribution. So your contribution, you have to pay tax on the contribution, but all the future earnings are going to be totally tax-free. So if you can think about it in a real tangible way like that, all of a sudden it starts to go, oh, so I don't have to pay taxes on anything that thing ever produces ever again?
Yeah.
Now, we can't all be Peter Thiel, right? You know what he did?
Yeah.
He bought PayPal with his Roth IRA. Now he's got hundreds of millions of dollars in his Roth IRA.
Must be nice.
Must be nice, yeah. Not everybody can do that, and we can't, we're not going to go find that get-rich stock or whatever. But the pure tax benefits of paying tax on that seed, especially as you're younger, and letting all those earnings grow totally tax-free, that's a big deal.
It is a big deal.
Now, let's fast forward a little bit. Let's just assume that this young couple, they're now up into their mid-40s. They're starting to earn more money.
Okay.
And, the lines between whether they should continue to contribute to Roth versus whether they should switch over to do traditional can kind of get blurry in the 40s there, right?
Yeah, definitely can.
Because they may have a need for that tax deduction. They may be at a point where they can start looking forward and saying, here's where we're going to be in retirement. I think to me, that's the blurriest time of whether I should contribute to Roth or whether I should contribute to traditional.
Yeah, I'd agree with that.
Once you get into your 50s and you're in your peak earning years, to me, it becomes easier to calculate.
Yeah.
So let's just say, for an example, Will, that we had somebody that's in their mid-50s, they're in their peak earning years, they're showing up and they're in the 32% bracket today. You've done your financial planning for them as a certified financial planner, and based on their income objectives in retirement, they're only going to be in a 22% bracket in retirement.
Okay.
Should they do a contribution to a traditional 401k, or should they do a contribution to a Roth 401k?
Well, it's still not 100% black and white, but more than likely doing the traditional is going to make the most sense because they are paying 32%. So they can save, 10% now. I think where it could get a little blurry is more the long-term estate goals and how they want their estate and how the kids are going to be taxed. But obviously that's a whole other discussion and topic.
But if they did, let's just walk this through. I'm 55. I'm not 55. I'm older than that. But let's just say, I'm the example here. I'm 55 years old. I'm in my peak earnings year. I'm in the 32% bracket. I want to max out my 401k. I want to put in my 27,000 or whatever I can get in there. Let's just make it 20,000 for round numbers here. I'm at a 32% bracket. I'm putting 20,000 into my 401k pre-tax, traditional side of my 401k.
Yeah.
I'm saving $6,400 a year in taxes to put that $20,000 in.
Yep.
If I can be in a 22% bracket once I retire, then what I can do is I can start taking some of that traditional that I've rolled over to an IRA,
Yep.
and I can convert it to a Roth after retirement in the 22% bracket.
Correct.
So I got to deduct the contributions at 32%. Now I pay on the conversion at 22%. That's where you said you're 10% ahead.
Oh, yeah.
And that's almost a 30% spread,
Yeah,
Bill.
it's huge.
Right?
It's massive.
Yeah. So, and then once you convert, it's like you paid taxes on that seed again, the conversion, right?
Yeah.
And now all the future growth on that Roth conversion also is tax-free. Now there's this 5-year rule on the Roth IRA and the conversions. You want to talk a little bit about that?
Yeah. So unlike with the contributory Roth, clock starts the second you put a penny in, right? The very first contribution, that starts your 5-year time window. Where it's different with the conversion is each conversion technically has its own 5-year time window. Now, that for most people, that shouldn't be an issue because, number one, we're probably not going to be touching that Roth for a while, more than likely. The other part of it is that Roths are set up on an accounting method of FIFO, so first in, first out, right? So even if they did have to get into it a little bit, so let's say we converted $20,000, right? And 3 years down the road, oh, there's an emergency. I don't know why, but I'm going toward my Roth. We can still get that principal out that we put in.
You can take that full 20,000 out, no penalty.
Correct. No penalty.
It's only if you take out anything in excess of that. So it's the earnings
Correct.
on that conversion that have to be in there for 5 years.
Correct.
And it's 5 years and 59 and a half, right?
Yep.
So it's not just a 5-year time frame to avoid the 10% penalty. It's a 5 years and 59 and a half.
Correct.
So if somebody was 50 years old, let's say they were laid off for a year and they weren't going to have any income and they wanted to convert all the way up to the top of the 12% bracket, so they converted $83,000 to their Roth IRA, they can still access that $83,000 without penalty.
Correct.
But if they take out more than that $83,000, in other words, any earnings prior to 59 and a half, they would also pay a 10% penalty on those earnings.
Yep. Plus ordinary income.
Yep. No, not ordinary income. It's just the just the penalty. Yeah, ordinary income would be for the traditional IRA, but so just
Correct.
for the Roth, it's just the 10% penalty because they already paid taxes on the actual contribution or the conversion in this example.
Correct.
So when we start looking at Roth conversions post-retirement, so somebody's already retired, let's say they retired in their early 60s, why does it make sense to look at Roth conversions after somebody's already retired?
Well, I mean, a lot of times if you've done a good job of savings, you've got money in the different tax buckets, and if you have money in after tax, well, we may be able to live on that bucket, take down not just interest but also principal. Therefore, kind of tricking Uncle Sam thinking that you're really not earning anything. Well, that opens up that door to be able to do the Roth conversion, even do more of a conversion, and really try to maximize as much as we can, getting from tax-deferred status over to tax-free.
Where, as a certified financial planner, Will, does Social Security planning or RMDs come into the decision to do a Roth conversion or to not do a Roth conversion? Let's tackle each one of those separately because they are two totally separate issues that people have to face if they're going to plan to do a conversion after they've retired.
Correct. So let's start off with Social Security, right? Number one, most people don't know how it's taxed. So first we have to look at the provisional income test. So again, taking all sources of income, even municipal bond income, so tax-exempt income that potentially is federally tax-free, that all goes in this calculation, and then half of your Social Security benefit. And then when you hit certain levels, now some of your Social Security becomes taxable. So we want to understand that dynamic as we're doing the income planning, right, while we're in our 60s, and say, okay, well, we have these different buckets of money that we can lean on along with our fixed income of Social Security. When do we turn on Social Security? And does it create more taxable income? And then also, again, are we creating an issue? And we talked about this in one of the episodes a while back about the taxation of Social Security. So I think those are all considerations that we have to think about, because that's just getting in the way of being able to do conversions, which again, then long-term kind of goes into, well, how did that change my required minimum distribution later on in life?
So I've seen this happen in a couple of different scenarios, Will. In scenarios where somebody has done a good job of creating what we call tax diversification, where they've got a lot of money in not just traditional, but also they've got a good amount in Roth, and then they've got a good amount in a taxable account. Doing that Roth conversion methodically over time, living on that taxable account, that can really reduce that required minimum distribution from the traditional IRA and avoid you from jumping up into that next bracket when the required minimum distribution start. It can also keep your Medicare premiums lower for a longer period of time because those RMDs don't get so big. That's a whole different scenario, though, than somebody who has saved the majority of their money in a traditional 401k, and all they have is the traditional 401k, which has been rolled over to an IRA, and then they have their Social Security.
Yep.
Right? So that person has almost feels like painted themselves into a tax corner.
Yeah.
But we've done strategies, and this is not one that I'm going to say everybody go out and do this, but we have seen scenarios where somebody has done a good enough job saving into their 401k plan that a normal systematic withdrawal, say of 4 or 5%, gives them all the money that they need to live on, and they don't even need their Social Security benefits to pay for their bills. And so that person, in a real world scenario, without working with a certified financial planner, might just say, well, if that's the case, I'll let my IRA keep growing. I'll defer my Social Security out to age 70. That check's going to get bigger, and then I'll worry about the RMD number when that comes out there. Yeah. And that is the tax time bomb that Ed Slott refers to in his original book, The Retirement Savings Time Bomb and How to Diffuse It. And then he wrote another one recently, The New Retirement Savings Time Bomb and How to Diffuse It. So I've done scenarios before, Will, where I'll say, you know what, here's the thing. We know we're not going to need Social Security as a means of living expenses. Let's then go ahead and turn that Social Security on early. Let's use the amount of money that's coming from Social Security to actually pay the taxes to convert from a traditional to a Roth. So I'm going to use my Social Security check to pay the tax to do the conversion.
Yeah.
And you'd have to run the numbers on that, but a lot of times what I've seen is that winds up reducing the long-term tax bill, and people that are in that scenario, they're going to leave a lot of money behind. But if they don't do some sort of conversions, they're going to wind up leaving an account that is infested with taxes, and under the new Secure Act, their beneficiaries are going to be forced to completely empty that IRA within a 10-year period. And most of the people that are inheriting those traditional IRAs are inheriting while they're in their peak earning years. So now we could be taxed at 37, and by the time 2026 rolls around, it's 39.6 plus the state income tax. Yep. So easily, 45% of that money could be gone to Uncle Sam if that's left in the form of a regular inherited IRA. But if you've done some conversions and the beneficiaries get the Roth IRA, it's a different story.
No, completely different story. Since the Secure Act came out, I've been basically telling my clients, you really got to think long term and essentially, put yourself mentally into one of two camps. So when you're thinking about this long term for both you and your wife or your spouse and the kids, okay, well, now I'm passed away. I'm dead. Don't care. Kids should be grateful they got a penny. Right. So if we lean in that mindset, then really it's about focusing on while the two of you are alive. Right. Because we want to understand what your taxes look like. Another scenario is what happens if one of you dies young. Right. And now we have the others on singles brackets. So now we have to deal with that. The other camp to the Secure Act mindset is this isn't my kids' money, it's mine. And this is Uncle Sam's way of gigging me while I'm in the grave, and that really ticks me off. Well, if you fall more into that camp, then we now have to think about, okay, when could you potentially pass away? What does it look like? Where are your kids at in life and their taxes? And then we got to start to really optimize for everyone. So there's a lot of decisions and a lot of moving pieces with those scenarios.
The other thing is when you start doing those conversions in retirement, it can also affect your Medicare premiums.
Yep.
And that is the IRMA rule. So explain that.
Yeah. So what a lot of people, again, don't know is our Medicare premiums are income tested with the IRMA rules. So essentially we have brackets and just to talk about where they're at for this year, and they do change. So right now, if your modified adjusted gross income in 2023 is below $194,000,
that's a married filing joint.
Married filing jointly below $194,000, you pay your base rate for your Medicare Part B and your base rate for your drug card. Well, if you go $1 over that, then you're up to $230.80, an additional $12.20 on your drug card.
So you went from $164.90 to $243.
Yep.
And if you go $1 over $246,000, now you're up to $360,000, $360 a month. So those Medicare premiums start to go up pretty quick. And this is one of the things when people are thinking about doing Roth conversions that they don't think about. So let's just say, for an example, that you're doing some planning for a person and they're anti-Roth conversion. You have a tool that will fast forward them to their required minimum distribution date, and it'll mock up a tax return for them that first year, and it'll show them what was the effect of the required minimum distribution in that first year of an RMD. And then you can use this sheet to say, and this is what it did to your Medicare premium and how much more that went up.
Yeah. Actually, I mean, the planning software will actually even show us that in the software itself. And that could be something in effect. Let's paint the example. Here in Kansas City, we got a lot of engineering firms. And these engineers have an ESOP plan, which owns company stock. And a lot of these engineering firms do very well. So they've made multiple millions of dollars for a lot of people. Well, again, that's all tax deferred, which could really amp up that required minimum distribution later in life, where you could be locking yourself up into a higher IRMA bracket, not even knowing it.
Yeah, you can get up in there. So you can get to premiums that are $637 a month in Medicare premiums per person.
Per person.
Per person. That's all the way up from the original $164.90.
Yeah.
So that's another $12,000 a year that you're paying in Medicare premiums just because your required minimum distributions got too big. So there's a reason for getting more money into a Roth, both pre-retirement and post-retirement.
Oh yeah, by far.
And it's more than just the tax bracket itself, because one of the things that you mentioned when you're talking about the taxability of Social Security, and you were talking about figuring out what the modified adjusted gross income is, or provisional income, however you want to say it. One of the things that you didn't mention is that one kind of income that does not show up to determine whether Social Security is taxable or not is income from a Roth IRA.
That's very true.
So a Roth IRA cannot cause another dollar of Social Security to become taxable. A Roth IRA cannot cause a capital gain or a dividend that could be tax-free to become taxable, but a distribution from a traditional IRA can cause $1 of Social Security become taxable, or 85 cents of Social Security become taxable for every dollar you take out. It could cause $1 of dividend or capital gain to become taxable that was otherwise tax-free for every dollar you take out of that IRA. Yep. So that locks you in, and you can find yourself in a scenario where you're taking $1 out of your IRA and you're losing 57 cents out of it to additional taxes. And you're like, well, there's no 57% bracket. Well, when you take into consideration that it can cause other pieces of income that otherwise would not be taxable to become taxable, then it does get that way. So this is a super, super complex part of retirement planning that most people never, ever understand.
It is.
They simply get the income that they get from wherever they get it. They take the information, they give it to their CPA. The CPA says, this is how much you owe in taxes. And you're like, how is this possible? How could I possibly owe this much? Because the tax code in retirement is super complex.
It is. Yeah.
And the Roth IRA is the best tool to fight that tax code in retirement.
It is.
So
it certainly is.
Start out young. And if you're older, you're retired, you're watching this, tell your grandkids, when you get into workforce, go to the Roth 401k immediately. Don't do the traditional. You don't need the tax break when you're in a 12% bracket.
No, not at all.
You need tax-free income when you're in retirement. And if you're of the same camp that Will and I are in, and you think that tax rates have to go up in the future to tackle the mountainous deficit that our country is running, then there's a really good chance that you're going to pay even more than what current tax rates are in the future.
Yeah, by far. And that's something we got to give a lot of thought to it. Obviously, you don't know what the future holds. I don't know what the future holds, but I mean, it's anybody's guess. But yeah, more than likely taxes are probably going to be higher in the future than lower.
Think about it this way. Would you ever go buy something today that you don't necessarily need? So maybe you're going to spend the money on something you don't necessarily need today, but you're going to buy it because it's on sale and you know you're going to need it in the future.
Yeah, I see nothing wrong with that.
Right, because you're saving money, right?
Yeah,
even though you spent a little bit a day, you know over the long term you would have had to spend more for that, right?
Yep, exactly.
So what I want people to consider is that the tax rates today are on sale. We know that the Tax Cuts and Jobs Act is going to sunset December 31st, 2025. So January 1st, 2026, all of our tax rates are going to go up. So if we can prepay some taxes by doing Roth conversions prior to January 1st of 2026, we all of a sudden paid our taxes at a discount.
Exactly.
We got them on sale.
Yep.
Because we would have had to pay them in the future anyway, but at a higher rate.
Yeah. And that goes into, I mean, so say we do your projection and you're one of those people that are going to be in the 12 or AKA 15 for the rest of life. Again, we have 3% off right now. Why would you not do it? Maximize it always.
Right. And that 3% of 15 is really a 20% savings in the taxes that you would pay.
Yep.
So taxes are on sale today. Look, if you're working with a good certified financial planner and you're meeting with them throughout the year, that certified financial planner's got a CPA in the room with you that's doing those longer term tax projections, you're going to be able to take advantage of these things.
Yes, by far.
But if all you're doing is just blindly saving into whatever you're saving into, or just blindly withdrawing out of whatever account you feel like you want to withdraw, inadvertently, you'll wind up overpaying your taxes. You'll wind up paying more than what your fair share is. And it's not because your tax return was done wrong. It's because you missed opportunities.
Yeah, you didn't plan.
Roth IRA is the best opportunity out there than I owe, Will.
It is.
All right. Well, hopefully we've helped our listeners and viewers understand more about the importance of Roth IRAs, Roth 401ks, both before and after retirement. So you can do Roth contributions and you can do Roth conversions. Roth contributions are only while you're working and have earned income, but Roth conversions can be done anytime, and they do not have an income limit that prevents you from doing a Roth conversion. So I would encourage people to talk to one of our certified financial planners, use our guided retirement system, and let's determine how we can get the most money possible into Roth IRAs with the least amount of tax as possible, therefore reducing your tax burden as much as we possibly can over your lifetime.
Yeah, no, that's exactly right.
Will, thanks for taking time out of your busy schedule to join me here on the Guided Retirement Show.
Thank you. Thanks for having me.
Thanks for joining us here on the Guided Retirement Show. We hope this has helped open your eyes a little bit to the power of the Roth IRA. Make sure you subscribe either on YouTube or your favorite podcast app so that you get notified every time a new episode comes out, and make sure and share this with your friends. Don't forget, we're offering you access to the same financial planning tools we use for our own clients. Just get out to the link in the show notes and click the Start Planning button and begin your retirement plan from the comfort of your own home.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Barber Financial Group and SEC registered investment advisor.